If you walk into a traditional bank today, you see exactly what they want you to see. Vaults, bulletproof glass, smiling tellers. It feels heavy, it feels permanent, it feels safe. But behind those marble pillars, the actual vaults are practically empty. The money isn't there. In fact, if you tried to trace a single dollar from your savings account through the global economy, you'd quickly realize something deeply uncomfortable. The real banking system doesn't have buildings, it doesn't have tellers, and it doesn't follow a single law that governs a traditional bank. Right now, there is an invisible parallel universe moving over $100 trillion around the globe. It controls the price of your mortgage, the stability of your pension, and the survival of entire nations. Yet you cannot open an account with them. You cannot look at their balance sheets. Almost nobody notices this. We've been conditioned to watch the central banks, to freak out when interest rates move by 0.25%, and to look at Wall Street as the ultimate seat of financial power. But while everyone is staring at the stage, someone else is completely redesigning the theater. The numbers tell a strange story. Traditional banks are shrinking in importance every single day, and the entities replacing them are operating completely in the dark. Most people believe that when the government passed massive stacks of regulations after the 2008 financial crash, they fixed the system. We were told the giant commercial banks were put on a strict diet. They were forced to hold more cash, take fewer risks, and stop gambling with public money. The explanation everyone accepts is that our financial system is now safer, more transparent, and heavily policed. The truth is far stranger. The regulations didn't actually destroy the risk. They just forced it to pack its bags and move across the street. By making traditional banking incredibly expensive and heavily regulated, the lawmakers inadvertently created the perfect breeding ground for something else. A system where trillions of dollars could be lent, borrowed, and leveraged without a single regulator breathing down anyone's neck. They wanted to clean up the kitchen, so they just swept all the radioactive waste under the rug. And now, the rug is starting to move. Which leads to a question that doesn't seem to make sense. If these invisible institutions, collectively known as shadow banks, are now doing the exact same job as traditional banks, why are they allowed to exist without the same rules? If a normal bank needs a mountain of paperwork and billions in reserve cash just to hand out a corporate loan, how can a private credit fund write a check for the same amount using money that is essentially invisible to the public eye? Who gave them the keys to the global economy? And more importantly, what happens when a bank that doesn't technically exist goes bankrupt? To understand how we got here, we have to look at the financial plumbing, the pipes that move money around the world. In the old days, the plumbing was simple. You put money into a savings account, the bank kept a little bit of it and lent the rest to a local business. The government insured your deposit. If the business failed, the bank took a hit, but you were fine. It was slow. It was boring. But then the plumbing changed. The world got too big for boring banks. Giant corporations needed billions of dollars in hours, not months. Billionaires needed places to park astronomical amounts of wealth where inflation couldn't touch it. Traditional banks couldn't keep up with the speed, and more importantly, they weren't allowed to take the kind of insane risks required to generate massive returns. So a new breed of financial architects built a bypass, a secondary, unregulated network of pipes. They realized that if you don't call yourself a bank, you don't have to act like one. Here where things become interesting. If you look at the biggest companies in the world today, the ones buying up all the suburban housing, the ones funding the private rocket companies, the ones bailing out failing cruise lines, they aren't going to JP Morgan Chase or Citigroup anymore. They are going to private credit funds, hedge funds, and special purpose vehicles. These are the shadow banks. They don't take deposits from everyday people. Instead, they take money from massive pension funds, university endowments, and sovereign wealth funds. They take the money you're counting on for retirement, and they inject it directly into the high-risk, high-reward underbelly of the corporate world. The obvious explanation you'll hear from economists is that this is a good thing. It drives innovation. It provides liquidity where traditional banks can't. But that creates another question. What are they actually doing with that liquidity? The hidden explanation is much darker. Because these institutions operate outside the regulatory perimeter, they can use a financial trick called a payment-in-kind loop. Imagine you owe someone $1 million and the interest is due. You don't have the cash. In a normal bank, you default. The bank takes your assets and the ride is over. But in the shadow banking world, the lender can say, don't worry about the cash. Just give us another piece of paper saying you owe us even more money later. They are literally paying off debt with more debt, creating a closed loop of imaginary value. On paper, the shadow bank looks incredibly profitable because its assets are growing. In reality, they are just collecting a pile of promises from companies that are fundamentally broke. It's an optical illusion disguised as an investment strategy, and it works beautifully right up until the moment someone asks for their actual cash back, which leads to something even stranger, the sheer scale of this illusion. Today, the shadow banking sector is estimated to be worth over $100 trillion. That is significantly larger than the traditional commercial banking system. It is larger than the entire GDP of the planet. Think about the contradiction there. The primary system, the one we vote on, the one we regulate, the one we see on the news, is actually the smaller system. The secondary, invisible system has become the actual engine of global capitalism. And here is the ultimate punchline. Because the traditional banks are deeply connected to these shadow funds through the financial plumbing, they are exposed to all of that hidden risk. The commercial banks are lending money to the shadow banks, who are then lending it to zombie companies using loops of imaginary debt. The system isn't safer, it's just harder to see. If a major shadow bank collapses today, there is no government insurance policy. There is no FDIC logo on their website, but their failure would instantly trigger a leak in the main plumbing, dragging down the traditional banks right along with them. The people who benefit from this setup are making historic fortunes today because they don't have to pay for the regulatory breaks. But if the car crashes, who do you think is going to pay for the tow truck? It's always the taxpayer. It's always the person who didn't even know the race was happening. The next time you see a headline about a traditional bank opening a new branch or reporting steady earnings, remember that you are looking at the facade. The real decisions, the real leverage, and the real risk have migrated somewhere else, into the quiet, unmapped territory of global finance. The system was redesigned right in front of us, and we didn't even notice because we were looking for the word bank on the door. But you don't need a sign on the door when you already own the building. The illusion of safety is always more comforting than the reality of risk. While regulators spend their time policing the visible architecture of finance, the true power has shifted to an invisible network of shadow institutions that run the world on promises and hidden leverage. The question isn't whether this parallel system will fail, it's whether we will even see the warning signs before the plumbing completely breaks.